Nifty and Sensex end over 0.5% higher. Buying in large banks helps the Nifty end above 25,200. HDFC Bank, ICICI Bank hit record highs. Mid-caps underperformed the blue chips.
Paytm posts a profit in Q1 on the back of lower direct and indirect cost and lower ESOP charge. And while some analysts see this as a positive sign, others point to concerns on the revenue front.
A block deal in Lodha Developers of nearly 2,000 crore and one in Oberoi Realty of nearly 1,400 crore initiated by an institutional seller drags down the two realty stocks.
Hello and welcome to Markets Forward, your go-to show where we aim to get you up to speed with regard to today's trading action and we set you up for tomorrow. I'm Nigel. With me is Rima. Hey, Rima.
Hi, all in all, a good session. The Nifty closes above the 25,200. The global setup helped. The trade deal with Japan helps. Asian markets were higher. Europe closed up with significant gains. And then you had those two, HDFC Bank, ICICI Bank, continuing to bat for the bulls.
Well, that's right, Rima. And, Trump is talking about making America great again. But for today, the Japanese index was much greater, because the index went on with gains and the automakers were there. They were up anything between 8 to around 15% or thereabouts. But let's give you a quick run through of what went on today. The Nifty, as Rima said, hit 150 points. Good news. Both the pillars of the market did pretty okay. You had, the Nifty Bank as well as the tech index. Both of them put on some weight. So that was good when both the pillars do well. In terms of advanced decline ratio, well, that should come up for you. It was pretty much even Stevens by the time we did wind up. And there were plenty of stocks, actually, that were moving around.
Okay, we'll discuss all this in greater detail on our show. We'll get you all the big news, the key developments in Dalal Street, the top corporate voices, the key events to track. But first up, as always, let's get to the big movers of the day. It's over now to Hormus, who joins in. He's at the big wall. Hormus?
Well, it was an interesting session for the bulls, and it was the index heavyweights that continued to bat for it. Both HDFC Bank and ICICI Bank ending at a record high in today's trading session. And Infosys, until the last 10 minutes of the trading session, was among the top gainers, and then it saw a very sharp reversal towards the close of trade. And Reliance Industries too, aiding HDFC Bank and ICICI Bank in the upside in today's session. A lot of earnings reactions took place during the day, some of those that were reported last evening as well. Take a look at these. Aditya Birla Real Estate earnings came out today. Sky Gold saw a slew of block deals after its results. Blue Jet Healthcare down 10 yesterday, down another 10 today. Idea Forge continuing to take an 8% knock, and Jana Small Finance Bank too after its results down 7%. Some of the other newsmakers in today's session dominated by block deals. Ola Electric is one of them, 6.5% higher. Bombay Dyeing saw a block deal in the dying minutes of the trading session, 14% higher on that stock. SML Isuzu, well, another 500 rupees and the stock will be now 3x from the open offer price of M&M. And Lodha and Oberoi Realty, the two block deals of the morning in today's session. Stocks that ended at a 52-week high today. Some interesting names here. Datamatics, Credit Access Grameen is an earnings reaction, and JM Financial ending at a 52-week high today with a 5.5% pop. And lastly, volume-led movers today. Green Panel Industries was one of them, 8.5% higher here. PNB Gilts is an earnings reaction, but on very strong volumes. Shall be moved higher today with a 7.5% move, and Godrej Agrovet and MRPL2 seeing healthy gains on very strong volumes. Back to you guys.
Thank you very much for that. Let's zero in on Paytm because that posted a Q1 profit driven by lower costs. Some analysts viewed this as a positive sign, but some are concerned about the revenue outlook. So it seems to be a mixed house when it comes to Paytm. Gaurav now joins in with the details and the bull and bear argument on Paytm.
Well, yes, when we talk about Paytm now, we have seen some kind of mixed reaction from the investors. And the reason being that first is that the results were very strong. Paytm, in fact, reported profits of around 120 crores in this quarter, which was actually not expected by any of the consensus players. But now there are two cases, bull versus bear. First, let's talk about bull, where Jefferies has upgraded the stock to buy and also increased the target price to 1250. What they're saying is that EBITDA definitely was higher than what the street is expecting. MTU, which is monthly transaction user growth, that was actually encouraging. And on the other hand, what another point that they have put is that when it comes to valuation, they believe that it is trading at a discount to a company, tech company like PB Fintech, and that is the reason why they are being bullish, because they believe that there is a compounding story from here on in terms of Paytm. In fact, Citi also maintained their buy rating and increased the target price to 1215 rupees. On the other hand, on the bear side, we have got CLSA, who downgraded the stock to outperform and gave a target price to 920. Now, this downgrade is specifically because of the outperformance that we have seen for the stock. Let's not forget that in the last 1 month itself, stock has rallied more than 20%. So what they're saying is that definitely the stock performance was actually higher than the street's expectation. But there is another point that they have highlighted. It is that when we talk about the loan distribution, Paytm has actually discontinued their default loss guaranteed loans from one of their largest lending partners, and this is the reason why they believe that the upfront cost has come down because of the DLG loans are not there. But on the other hand, in terms of revenue, the deferred revenues are still reflecting, and that is the reason why they also believe that the EBITDA can actually come down. In fact, they have also cut down their EBITDA guidance and EBITDA expectations almost by 4 to 8% for the next 2 years. So definitely that is another case that they have put in. We also have Macquarie, who has maintained their target price of 760 rupees. So as a result, we are seeing some volatility in the stock. So definitely in terms of numbers, they were good. But in terms of brokerages, we are seeing two groups which are forming right now.
Thanks a lot for that, Gaurav. Well, let's get in our guests. Then we have Shrikant Chauhan of Kotak Securities, as well as Mayuresh Joshi, a Director of Research at MarketSmith. Hi, gentlemen. Thanks a lot for joining in. Mayuresh, Paytm करोगे ना?
मैं Google Pay करता हूँ. But however, I think the numbers were encouraging, Nigel. No two ways about it. Two things I think that stand out in the bear and bull case argument that has been put forth. I think what will be the proof of the pudding will be the coming quarter. I think if in the coming quarter you see a similar trend emanating from Paytm's numbers, specifically when it comes to the EBITDA and the bottom line, I think the street will then recognize that there is a strong turnaround case that is happening in Paytm. But till that point of time, I think the street might just consider, because of the huge outperformance in terms of price, that a lot was gestated over the past few weeks and months on whatever has happened in terms of the operating parameters that Paytm has delivered so far. And therefore, our sense is that we are having a neutral rating on the stock as we speak. Anybody holding can continue holding. But I think the next quarter's numbers are going to be extremely, extremely important for Paytm. If they're able to deliver, I think there can be a huge move even from the current levels if that sustains till the next quarter numbers come.
Okay, all right. Shrikant, what about you? How's it looking on the charts?
Yeah, it looks really a very strong candidate to buy and hold with a positional view, because currently the stock is very close to its overbought level. And the company has also announced its quarterly numbers. So broadly, I am of the view that it is very close to the overbought level. So for short-term traders, it's not that easy to trade in this stock. But if there is a positional view of, let's say, 3 months, then I think it is heading for the levels of 1400. So it is into the pullback mode of its entire fall that we saw from the, I can say, after the listing of the stock. So it is retracing to that particular level, and in case if that happens, then the stock can move towards the levels of 1400 or 1450.
Okay, guys, Infosys numbers are flashing for you on your screen, and the first take is it's a revenue beat. The company has reported a constant currency revenue growth of 2.6% quarter-on-quarter versus estimates of 1.5%. Anyway, Infosys was expected to be the only IT company in the large cap space to report growth this time, but the growth is much better than expectations. So 2.6% is the top line revenue growth, a beat. Margins have come in at 20.8% versus 21%, so a drop of 20 basis points sequentially, but that comes in line with expectations. Now to the FY26 guidance. The revenue guidance stands at 1 to 3% versus 0 to 3%. That is in line with market estimates because the street was saying that anyway the company, had done two acquisitions, the MRE acquisition and the Missing Links acquisition. These two were expected to contribute to the FY26 outlook, and therefore the lower end of the guidance was likely to be raised. So the guidance doesn't come as a surprise. It's an upgrade at the lower end. It stands at 1 to 3%, but it's in line with expectations and expected courtesy on account of the two acquisitions, small tuck-in acquisitions, which they did in the prior quarter. So that was going to benefit. Margin guidance has remained unchanged at 20 to 22%. Again, in line with street expectations. The deal wins have come in quite strong at $3.8 billion. Now, this compares with about a $2.6 billion in the prior quarter, and the last 4-quarter average was also about $2.5 billion. So deal wins has seen quite a bit of a tick up, and the company says that the large deal win TCV is 3.8 and 55% of it is net new. So all in all, it's a good quarter for Infosys. There are no big misses right now. Revenues beat, margins in line. FY26 guidance on expected lines has been narrowed on the revenue end to 1 to 3%. Margin guidance has been upheld. Just trying to read the statement that Salil Parekh has made, and if you can glean anything from his statement on the environment. Okay, so our performance in Q1 demonstrates the strength of our enterprise AI capabilities, the success in client consolidation decisions, and the dedication of all our employees. Our large deal wins of $3.8 billion reflect our competitive positioning and deep client relationships. So that is, the statement that's coming in from Salil Parekh. But the growth this time has been industry leading at 2.6%, much ahead of expectations. The company has executed very well, and they've largely managed to protect their margins. And deal wins are also very promising, $3.8 billion. So it's a good start, to the year for Infosys, and it's a good way to end the IT earnings season, at least for the large caps. Prakash is now joining in. Prakash, through the day, Infosys was going into its earnings with strength. It's only towards the end that you saw the stock falter. There was some nervousness which kicked in and the stock fell in the dying minutes of trade. Your thoughts on Infosys Q1 numbers?
No, I think very, very heartening to see these numbers. As you rightly said, the word growth could only go with Infosys, not with the other three major IT players. And what it also does is it probably starts, bringing up the possibility of a very disproportionate allocation to Infosys within fund portfolios. Institutions have been really, I'm sure they're worried about the lack of growth and the negative growth and all that in some of the other names. But here you have something which continues to deliver. And remember, the new orders, 58% is from, the order book is from newer orders, which is exactly diametrically opposite of what others have been reporting. So I think on all counts, it's done well and it's promising to do well. As of course, we'll see the fine print within the commentary, hear them out. But my sense is that this is a stock that will see serious allocation come its way as compared to the others.
Okay, I remember last quarter, Infi was a miss. The street was disappointed. So it's good to see the company make a comeback in Q1. Rahul Jain from Dolat Capital is now with us. Rahul, share your initial thoughts on Infi's numbers. How do they compare versus your expectations?
So we have to see it from two perspectives. Vis-a-vis what we were anticipating. So it's definitely a beat on that front because we were anticipating 1.5%. And that too driven by the inorganic contribution. This is much higher than that. And secondly, also from a relative point of view, the way we have seen other companies report in this quarter, this look significantly premium to that. However, one thing which is difficult to comprehend at this point is that the guidance they have scaled only on the bottom end at 1 to 3%. So that 3% number which has not gone on the top end is something to watch out for, because this would mean the implied growth for rest of the year may not be very exciting. So if they say that the inorganic contribution was higher and the guidance is X of that number, then it still look better. So that is one thing we need to see in the numbers.
Generally, when they change the guidance, it's always including the acquisitions because it's very hard to separate out the impact of the acquisitions, especially once the integration is done and you've got the whole year. But you know, Rahul, what they had said in the prior quarter when they gave that guidance of 0 to 3%, they said lower end, that 0% assumes a deterioration in the macro environment. The upper end, 3%, assumes steady to slight improvement in the macro. Now, between Q4 and Q1, we haven't seen the macro deteriorate. It's not improved, but it hasn't gotten worse. So maybe that also, along with the acquisitions, has given the management confidence about upgrading the lower end. And on the, when it comes to the upper end, though Q1 was a beat, they've still not gone ahead and raised the upper end. Perhaps it's just, one quarter and the dust is still not settled on the entire, on macros. It's not that clients have come out and started spending their unallocated tech budgets. So maybe they'll wait by to see one more quarter before tweaking the upper end of the guidance. But this is the fifth large IT company to report their numbers. Now, based on the first four numbers that we had, there was no confidence in IT or buying into the IT stocks, just purely based on the numbers that we had, negative revenue growth, companies are not giving wage hikes, margins came under pressure for a company like HCL Tech. In fact, they lowered the margin guidance too. Do you think Infy's numbers, because they're, it's a good set of numbers, right? No negative surprises. Investors will once again have confidence back in the sector? Or do you think it's going to be very specific to Infy?
Yeah, we have seen this in the previous quarter also, that only Infy HCL Tech at that point of time was confident on growth versus the rest of the pack. And this time HCL remained confident on the growth, but yes, margin they have disappointed. Now, with this, we won't see this helping anybody else because we are seeing that divergence in performance right from the previous commentary as well. So this is right now a positive for Infosys alone, but it definitely adds up to confidence if the commentary overall improves for them, because that will be reflected in others' commentary in the gradual period. But that we would learn once we see what they have to comment across vertical and geographies.
But it's definitely going to provide investors a sigh of relief because if you remember in Q4, Infosys revenues had dropped 3.5% quarter on quarter. So it was a low base sequentially, but the performance and execution has been on the stronger side. Mayuresh, you want to chime in with your view on Infosys? How does it stack up versus the rest? What's the positioning in your portfolio?
So as far as IT stocks are concerned, we are positioned in a couple of mid-cap names, Persistent and Coforge, in our portfolios. But as far as Infosys performance is concerned for this quarter, relatively better compared to the rest of the pack. And therefore, I think the revenue beat is something which, as you rightly pointed out, is a huge sigh of relief. The expectations in terms of margins remaining in the 20 to 22% band is a sigh of relief as well. And though I think the constant currency guidance growth of 1 to 3% has been up on the lower end, I think there is some expectations that at least for this year, assuming tariffs, discretionary spending, etc., that they'll still be able to manage some reasonable growth. So yeah, reasonable numbers compared to the rest of the pack. The stock should open positively too.
Expect the stock to open positively. Shrikant, what's the technical positioning in Infosys?
See, for Infosys, the stock has managed very well to sustain above the levels of 1550, 1530, despite there was weakness in the entire IT pack. So I'm of the view that the stock is again heading for the levels of 1640, 1650, where it has next leg of resistance. But broadly, I am of the view that this one is the relatively outperforming stock, and this may even also move towards the levels of 1700 or 1750. So broadly, I'm of the view that we should look for creating a long position, even if it is like opening higher to the levels of 1630 or 1650.
The company's hiring headcount addition has been muted. It's added about 210 employees on a quarter-on-quarter basis, and attrition has ticked up by 30 basis points to 14.4 versus 14.1% in the prior quarter. But attrition has steadily inched up for the company over the last 5 quarters now, from 12.6% in Q4 of FY24. It's now at 14.4%. Still perhaps in the comfortable range, but you have seen attrition pick up a bit. Rahul, the press conference is at 4:15. What would be the key watch points? What would be the questions if you had a chance to ask the management?
I mean, there are a couple of smaller print. One, of course, as you said, the commentary, the client sentiment, that is an obvious one to ask for. Within operating metrics, we would like to see, as you highlighted, the headcount has remained same. Utilization has gone up by 120 bips. So their thought process on further hiring and utilization is something which would add up to the confidence on how they are seeing the environment. So that would be another thing. And TCV win has been strong, but what we have seen in the past is a timely ramp up and customer confidence on that. So some of the feedback and those elements would be crucial. And of course, the inorganic element within the current numbers.
Got that. Mayuresh, deal wins are very strong, and they have been for a lot of the IT companies. Yesterday, when Zensar did their call, they said, in a way, I may be paraphrasing, that they're avoiding vendor consolidation deals because it's a race to the bottom. They're so competitively fought that even Wipro said that, right? These deals, cost consolidation, the cost optimization, vendor consolidation are competitively fought. There is pressure, and it's then up to the IT companies to try and optimize margins over the life of the projects and try and protect the margins. But, as, Zensar in a way said, it's a race to the bottom. So although you are seeing these large deal wins by the IT companies, do you think it's going to start hurting at the margin level? Because plus this, AI in a way is deflationary.
It is, Rima. And therefore, I think companies which will have a niche offering specifically in this space, I think they are going to benefit quite significantly. Because at the end of the day, if there is pricing-led pressures that probably come through at some point of time in the areas that a lot of these companies operate out of, and there are a lot of interlinked areas for a lot of these IT companies at play as we speak, that might create some element of hassles as far as the overall margin performance is concerned. And therefore, in my opinion, again, I think niche companies which have niche offerings are operating out of niche areas. I think they might actually be winners over the next few quarters.
Mayuresh, Srikanth, Rahul, thank you very much for joining us. It's the first day coming in from Infosys. Infosys clocks in a good Q1. Revenues come in higher than expectations at 2.6%, margins in line at 20.8%, profits too ahead of consensus expectations. The company goes ahead and raises the lower end of its revenue guidance for the full year. For FY26, they're now penciling in a growth of 1 to 3%, with the margin guidance unchanged at 20 to 22%. Strong deal wins perhaps gives the company confidence. Deal wins have come in at $3.8 billion. And also important to note that Infy is the only large cap IT company which has clocked in growth in the current quarter. This has been a tough quarter with the tariff uncertainty looming large on all macro decision. Clients have held back on their decision making. Many projects have been paused across the board in the industry. So it's been a tough quarter. Infosys has executed well and clocked in a growth of 2.6%. Well, that brings us to a close in this edition of the show. Thank you very much for watching. We'll come back with more news and updates.